Okay, welcome back. ICICI Lombard is the next management as promised on the program. The stock's higher. It was high yesterday after it reported good set of numbers. Net profits have risen 28% to 747 crore rupees. We are now joined by Gopal Balachandran, Chief Financial Officer at ICICI Lombard. Thanks very much, Mr. Balachandran. Good morning. Prashant here. So if you look at the net earned premium growth, that is in line. But if you look at the PAT growth, as I just mentioned, that is much higher, 28-29% kind of growth is what we've seen. Could you just briefly tell us what led to this very sharp move on the bottom line front in the quarter?
Morning, Prashant, and that's a great question. I think from an ICICI Lombard standpoint, I think we have maintained it even in our earlier calls. As a company, what we have tried to do is to stay focused and be disciplined in terms of our insurance outcomes. And more importantly, also kind of leverage the investment float that we kind of generate in our business and put it to optimal use. So the number of 28% growth that you see, I think the markets have been kind in the quarter. And therefore, to that extent, whatever growth that you see is a combination of both an improvement in our insurance results, which is largely reflected in the combined ratios. And equally, obviously, there has been an improvement in our overall investment income. A combination of the two is what has led to a growth in profits of 28%. But as we keep saying, I think some of these, how sustainable, I think better is to always keep looking at results more on an annualized basis. That will be far more reflective of what one can expect insofar as the full year operations are concerned.
Mr. Balachandran, and that was exactly my question, because during the quarter, because we get these monthly numbers, right? Except, I think, retail health, across all other segments, ICICI Lombard sort of gave up a little bit of market share. So is this performance sustainable, or do you think we will eventually see deceleration in premiums as well as we go through the rest of FY26?
Again, that's a great question if you ask us. I think that again, let me just put this in context. I think let's look at in terms of where the market is currently positioned as. One is in terms of what is it that you can exhibit as top line growth. And the second, what I said, what is it that one can exhibit in terms of profitability outcomes. If you look at the overall market, the industry is kind of currently losing roughly about 12 to 13 rupees for every 100 rupees of premium that you collect. So which is why the industry combined ratios are operating at around 113%. So when there is so much of underwriting losses, I think from an ICICI Lombard standpoint, what we have always tried to do is to obviously accelerate in segments which we think are preferred segments at this point of time. At the same time, be guarded and cautious and wait for the cycles to turn around and obviously seize the opportunity for growth as we head into the subsequent quarters. And that is how we have always operated as an institution. And that's the reason not just now, given at any points of time, generally if you see relative to the industry combined ratio number that I spoke about, ICICI Lombard's combined ratios have been kind of better by at least about 10 percentage points or thereabout. And to the markets, what we have been largely talking about is to see how we can continue to deliver a sustainable return on equity in the range of 18 to 20%.
Okay, all right. Hi, sir. Good morning. Good to see you, Ben. A couple of quick questions then. So you're saying that you'll outgrow the industry and the combined ratio as well will be far better. Could you put a number to that? What kind of industry growth are you working with? I think in the past you've said that you'll outbeat industry growth by 100 to 200 basis points. So do you hold on to that? Are you looking at any kind of price increases as well, price tweaking? Give us clarity on both those two fronts.
Again, Nigel, I think that's a great question if you ask us. So again, let me just put this in context. I think when we had kind of talked about us outperforming on growth exactly to the numbers that you indicated, which is about 100 to 200 basis points, that's relative to, let's say, where the market is expected to operate at. Vis-a-vis that, what we are seeing at this point of time is obviously elevated levels of competitive intensity. And therefore, to that extent is what I kind of talked about, to be a bit guarded or cautious. And in that context, I think we are happy to kind of let go market share, particularly around these times when the market remains elevated. Having said that, obviously on the segments where I think things have been reasonably good for us in terms of the pricing regime, I think we have continued to stay accelerated, whether it is growth in our retail health book, within the commercial lines, whether it is a growth in the SME segment, I think that continues to do well. Within the motor segment, if you were to see our shift in mix to private car relative to, let's say, commercial vehicles. So that's how we have kind of obviously kind of moved across business lines, depending on what environment that we are seeing in the market. The second point on
Price,
Where do we see the price? I think the good part is, again, let me kind of pick each of the segments. Commercial lines, if you recollect, last year had a tough time in the pricing market environment. This year, clearly, if you see the numbers, that is reflected for the overall industry also. The pricing seems to have kind of come back reasonably well, though not fully to our expectations, but there has definitely been a price improvement. On motor, I think there has obviously been from an industry an ask to possibly seek an increase in third party price. We will wait and see when that final notification comes through, and we'll be happy to talk through whenever it happens. But in general, there is definitely a need for price increase in motor because industry combined ratios on motor are operating at 124%. On health, I think again we have spoken about from an ICICI Lombard standpoint, the loss ratio range on an annualized basis, which we are comfortable with, is between 65 to 70%. And at this point of time, looking at how things are playing out for us, it seems to suggest that we should be within that range.
Sir, twice, thrice you referred to elevated competition in the industry and how one needs to be guarded. Can you describe a little bit more about what we're seeing with respect to the competitive intensity and what's the extent of market share loss that you've ceded? What's the number?
Yeah, so again, if you look at it, let's take individual segments. Let's take motor. We would have lost roughly about 0.5% market share. We touched almost close to about 11.1. As we speak, we are at a market share of 10.5%. And this is not just this time, Reema. I think in general, I think our approach, which is what I talked about, when I said the industry combined ratios in motor is at 124%, that is a lot more money to lose even relative to, let's say, the aggregate. What I said, industry is losing about 12 to 13 rupees for every 100 rupees of premium that they collect. So in motor, you're actually ending up losing almost 25 cents to a dollar. So that's a lot of money to lose. And therefore, in these times, it is far more important for us to make sure that we continue to stay invested in our service/distribution expansion initiatives. But at least insofar as growth is concerned, at an aggregate level, you will possibly see us underperforming the market. But this is how the nature of the business works. And hence, to that extent, I think we will obviously be able to kind of position ourselves far better. Whenever the cycle reverses, we'll be able to capture the opportunity of growth.
Are you comfortable losing more market share? I mean, what if the cycle doesn't reverse? You've already lost 60 basis points in motor, for instance. I mean, what is your plan B or the thinking behind it?
Absolutely. I think this is again, I think I would again kind of put this in the context of, because the informations are all in the public domain. I think companies which have tried to be very aggressive, again, if you would have seen over the last 2-3 years in specific, clearly you have seen them significantly getting impacted in terms of their combined ratio/profitability outcomes. And today, if you were to see the growth numbers of some of those players, they have significantly calibrated growth. And in some of the instances, they've actually kind of degrowing their book. So that's exactly what happens, particularly when you start to see your combined getting impacted, profitability is getting impacted, solvency getting impacted. So that's exactly the nature of the business that we are in. And over a period of time, and just to kind of refresh quickly, in motor, while I said currently we're at a market share of 10.5%, post-COVID, actually our market share came down to 9.5%. But since then, when we saw an improvement in pricing, we were able to improve the market share from 9.5% to 11%. And today, I think again, when the competitive intensity is far more elevated than what we would have expected, happy to stay guarded and cautious and wait for the cycles to reverse.
Very quickly, sir, you said you're going to be shifting more towards private in the motor segment. What is it at? What is the mix currently? Very quickly.
The mix for private is about 55%, two-wheelers is about 27%, and the rest is commercial vehicles.
Okay, all right. So you're saying greater focus on private, right? So the number goes to what?
So Nigel, again, let me just put this in context. This number is for the current quarter. Okay. If the market environment change, this mix can completely undergo a change.
All right. Not out of questions, but out of time. Thanks a lot for joining in. We look forward to having a chat with you, maybe in the middle before the next quarterly numbers.
Thank you, sir.
But it's time for our special